Okay, so going back to our, just to recap what we did in the last session, we were talking about the last point we covered. The important point is that when you are pyramiding, we are taking the example of TCS. When you are pyramiding, you should not be taking the, when you're calculating how much extra can be bought. Everyone understands the concept of pyramiding. It's adding to your position when the market is moving in your favor. Okay, so the question is, how much can you add? So we discussed this. So the rule I gave you is that when you already have previously profitable positions, okay, and you're adding new positions, you're already long some from here, you're adding new positions. When you decide how much to add and you're trying to see how much risk you can take, okay, what I said is that you should use the, you should take it on a gross basis. Your gross risk capital per trade, dollar risk per trade, or dollar risk per unique stop level. The dollar risk per trade is actually the dollar risk per unique stop level for every system. Okay, this is defined for every system, and that figure is 106,000 in our example. So you are planning to enter at 2235 here, the additional position, and planning to exit at this level. So 2235 minus 2207 is $28 per share. We are assuming it's not rupees per share but dollars per share. So 28 you're losing per share. To figure out how many shares you can buy, you have to divide 106 by 28, not, which gives you 3,786 shares, okay, which is the correct approach, and not, you do not get to divide 159,500 by 28 and come up with a much larger number of 5696, which is not the right answer. This is wrong. This is right. Okay, what we are saying. Of course, there's no real way to say that this is right or wrong, but I'm advising that you don't follow this approach, because here you take a lot. You see the position is much bigger because you have more money to play with. Okay, and how did you get this 159,500? You took the additional profit, that the profit that you'll make on the earlier positions. You put on earlier 500 shares long for the short-term system over here. That the trailing stop has moved from here all the way. It has moved to, it would have first moved over here, then it would have moved over here, then it has moved over here. So from here to here on 500 shares, you're going to make a certain amount of money, okay? And that money you are planning to add, you added that 159,500 comes from adding the previous profit on the previous leg, previous lot, to the allocated system risk for each position. So you have only $106,000 allocated, but you're adding the profit that you'll make on the previous lot, okay, and then taking this figure of 159,500, and if you divide that by $28 risk per share, then you're getting a much larger number of shares. So I'm saying don't do that. This is not to be done, because then you're using the risk limits on a net basis, because obviously if you do this, you will lose 159,000 on the new position, okay, but you will make 53,500, so on a net basis you will lose 106,000 only. But do not apply the dollar risk per trade on a net basis, apply it on a gross basis. Okay, that is the advice I'm giving to you. Okay, so this is basically the right way, because then this way you maintain a constant dollar risk per stop across all trades, and you don't allow the previous profits to be frittered away like this. Okay, playing with your previous profits, and it varies the dollar amount per trade, dollar amount at risk per trade, which is not good. So according to me, you should apply the risk per trade on a gross basis, not on a net basis. This is clear. This is what I mean by gross rather than net basis. Are you following? Yes? Okay. Next point we have to cover, not here, but here. So if we have already covered this concept of pyramiding positions, we already had an extensive discussion on pyramiding earlier in the couple of sessions earlier when we discussed this particular TCS example. That's why we went back to this TCS, the very same example from before. Some of the numbers may have changed because we don't have time to read the actual high lows. We are just going with the cursor values. Okay, so the other point we have to discuss is, so we have discussed risk per trade. Now you have understood the other concept we discussed is the extensive discussion on how to derive risk per trade by projecting the number of trades in your trading system, okay, rather than taking an arbitrary figure for risk per trade. Okay, the next point we want to discuss is system edge. Okay, this is also a technical term in trading systems lingo. We have to understand what system edge is. You are already familiar with the system. You know what is mathematical expectation from statistics? Yes? You know what it is? What is mathematical expectation in statistics? Have you not done this in your QT1 and QT2 or one of those cases? Probably QT2. Mathematical expectation? Yeah, probability times. So it is basically, the way to think about mathematical expectation is it's actually a weighted average. If you go back to even more basic concepts, everybody knows a weighted average. Okay, everyone is familiar with the concept of weighted average. So when you are encountering the new concept, usually you encounter weighted average before you encounter mathematical expectation in probability, right? So, but the way to understand it is that mathematical expectation is not really a new concept. It's the same as a weighted average. It's just what we should call a probability. Now you're using the probabilities as the weights. Summation PIXI is the way we remember the formula from statistics. Probability weighted average outcome. Okay. So mathematical expectation. So system edge is nothing but the mathematical. It's a new term that you're learning. It's actually nothing but actually can be explained in terms of old terms that we know. Okay, which is, Google is not smart enough to know that expectation is also a word, so they are giving it as an error. Okay, so now system edge, we are saying, is already can be explained in terms of concepts we already know, which is mathematical expectation. It's just the mathematical expectation of the trading system. Okay, so, and mathematical expectation, as you know, is already summation PIXI. Okay, so essentially it is just and so conceptually, if you want to understand it even more basic terms, it's the probability weighted average outcome of anything. Okay, and so weighted average. So it's just you use in fact you are using the probabilities as the weights. That's all it is. Okay. So the system edge for any trading system, the system edge is defined in this manner. Okay. So here we are assuming that, so there is something called an average loss in every system, which is basically going to be equal to our risk per trade. Okay. So 1 minute, let me just write the formula here. This is the formula for the part we discussed earlier. Okay. Number of losses. We can just write it like this. You remember what we did in the previous class? Right? We did the risk. I'm just writing the formula for your reference. Okay. So the reason we have number of losses per plus 1 ND is that Mehak has raised a good point, which we should think about more. But for the moment you work with number of losses per 1 plus 1. The reason you need that plus 1 is that the risk management rule is that once your risk capital has been exhausted, you have to stop trading. Once your risk capital has been exhausted, you have to stop trading. So if you divide by 375 and you are projecting 375 losses, right? Okay, because we can write this, since after exhausting risk cap, you have to stop trading. That's what your risk manager will tell you. If you're managing money for a fund and the fund had a certain amount of risk capital, let's say $20 million, and you have already lost $20 million, then you can no longer, you have to stop trading for the year. Okay, for that period, whatever the period is, quarter, year, whatever it is. Okay, so you have a risk capital allocation, you lose that amount, and you have to stop trading for the rest of that period. Okay, every risk capital amount is risk capital figure applies to some given period, quarter, month, year, okay, decade, whatever it is. Once you exhaust the risk capital figure, you have to stop trading. That's why you need to divide by 1. If you just divide by the number of losses and you have those 375 in the example that we took, okay, here we have a smaller number now. We can go back to that example. If you remember 375, we took 500 trades. So we are going to have 375 losses. The reason you should not divide by 375 is, if you divide 20 million by 375 and you take the risk per trade and you have the 375 losses, then at the end of 375 trades your risk capital is exhausted. Are you following? The full risk capital is exhausted. Okay, some of you don't attend the previous session, you will be lost obviously, but you have to go and watch the video. Yes, are you guys following? 375 divided by 20 million divided by 375 would be giving you some figure. If you take that figure into 375, it's already 20 million. Okay, then you have exhausted your full risk capital, so you can't trade anymore. That's what your risk manager will tell you. That's why you need to divide by 1, so that you have a little capital left extra. You have not exhausted your risk capital, so you can justify putting on the next trade. And after that, remember, you will have no more losses, because all your losses have been stacked up front. So now if your projection is correct, about 75% losses, all the rest of the trades will be winners. So there will be no losses from now on. Yes? So no more losses, so you don't have to worry about going below 20 million losses, right? So that's the number one reason why you need +1. Okay? Alright, so we go back to this. We have defined this in this way. This is the formula. Okay? Strip trading for that period. Alright, so we go back to understanding system edge. Very important concept in systems trading, to understand the system edge. If you are talking to professionals, they will use terms like system edge, so you have to be able to understand it. It's very simple. It's conceptually, it's the mathematical expectation of the system. So how do you compute the mathematical expectation of the system? Okay, first understand the mathematical expectation of a head. If you have a game, okay, if you have a game where, let's say, let's try to take a simple example of expectation. Maybe we should just take it here. Okay, so if you have a coin toss, okay, every time, let's say the coin probability of, it's a unbiased coin, so heads probability is 50% and tails probability is what, 60%? So we have 60%. So we have to always write it as we have to write it as 1 minus this. Okay, so every time you have heads, I'll give you you have to give me $1. So I'm writing it from your point of view. Every time you lose, every time there's a head, you will lose $1, and every time there is a tail, I will give you $5. I will give you $4. Okay, so how would you write the expectation of the system? Correct. Somebody said it correctly here. 0.5 into -1 plus 0.5 into 4. Okay, very good, excellent. So we can see how much money you're going to make. Okay, 50 into, we can just actually, you've done this before? Very good.
We did it in IPM only, starting the first few sessions.
You did it in IPM? Okay. So system edge has been covered in IPM?
No, the topic of mathematical
expectation has been covered in IPM. Anyway, it doesn't matter, we can just revise it quickly. So everybody understands this is how you got to calculate? Okay. So now suppose you have a system in which you have, now we already have some of the information that we need. Okay, so everybody understands how to calculate this. Okay, so we have to have the minus, so this has to be written as basically -1. Okay, or it has to be written minus into 1, where you have the 1 as the loss, and then we have to put a minus sign before it. I'm just stressing the minus sign because you need that in the calculation thing. Okay, so now let's see if we have information to calculate the edge of this system. We have represented a system over here, right? This system does 500 trades, okay, over 1 year. This system has, what information do we need? Here we had probability of loss, probability of loss, probability of win, and magnitude of loss, magnitude of win. Okay, so can we take, since we don't have that much time, I'm just going to do it as a lecture. Okay, can we take percentage losers as probability of loss? This is the frequentist view of probability. You have done Bayesian probability. What? Conditional probability you haven't done. That is, you've never heard of this guy Bayes' theorem.
Yes, sir.
Okay, so that is called Bayesian probability. That is conditional probability. The other approach to probability is what we call the frequentist probability approach. Here, but it goes by the frequency. So if I'm projecting a system which has a 75% loss rate, can we say the probability of loss is 75%? On average, 75% of the trades will be losers, so the probability of loss is 75%. Okay, so we have that information, probability of the loss. Okay, what is the magnitude of the loss? Have we computed the magnitude of the loss? Can you tell me what is, can you guys see at the back, Parul? Can you see the numbers? Yes or no? You can. So we have, we looked at we are trying to derive the mathematical expectation of the trading system, which in the industry jargon is called system edge. It's called the edge of the trading system, edge, okay? Like the edge of a ruler, okay? So the edge of the trading system, this is called, so this is the language that is used in the industry. So you're calculating the system edge. So you need percentage, so it's a mathematical expectation, so you need percentage probability of loss times magnitude of loss. So conceptually understand the formula for expectation of a trading system. Because your heads and tails tossing game, you already told me the formula for expectation will be probability of loss times magnitude of loss, which is here. You told me that it should be probability of loss times magnitude of loss with the minus sign, and probability of win times magnitude of win. So we are going to, since we told you that system edge is nothing but the mathematical expectation of the trading system. So when you're doing the calculation of system edge, it should be probability of loss times magnitude of loss with the minus sign plus probability of win times magnitude of win. Are you agreed?
Yes, sir.
Should be the same. And what we are saying is, according to the frequentist view of probability, if the system is projected to have 75% loss rate, okay, losing trades 75%, we can say the probability of loss is 75%. Okay, and the probability of profit is therefore 25%. So we should have probability of loss into magnitude of loss plus probability of profit into magnitude of profit, okay, a probability of win. So next thing we need in our first term is the magnitude of loss. So can you look at, based on the discussion that we had, can you tell me what should be the magnitude of the loss? We have 75, 25, 75. Where are you getting 75 from? 75 what? $75? Percent. No, that we have already discussed, that 75% is the probability of loss. Now we need the next, we need the magnitude of loss. Yes? 20%? 20 million is the magnitude of loss. We are talking magnitude of loss per trade. Yeah, so it should be 53,191 because that's what you're risking per trade. Are you following? That is what you're risking per trade. So every time the trade, we are going to make some simplifying assumptions that every time you lose money on the trade, every losing trade will lose the budgeted risk per trade. The dollar risk per trade, we can call it the budgeted risk per trade because we are doing an ex-ante budgeting exercise. How much are we going to risk per trade? So we are going to assume that every trade loses the budgeted risk. Okay, we can make that assumption. We can write it here also. Every trade loses budgeted risk. So we say that every trade loses the budgeted risk. You understand what I mean by this? That every time you have a loss, this will actually not be true in real life because sometimes you'll be able to move the stop a little bit, you may not lose the budgeted risk, but we have to make some simplifying assumptions. So when I say every trade loses the budgeted risk, which means the budgeted risk is 53,000 roughly. So 53K, every time you have a losing trade, it will lose this amount of 53K. This is clear? It will lose the full amount of 53K. Okay? Right? Yes, you have a question.
Can you please change it to 250 because it gets confusing every time you calculate.
No, but earlier we did 500 trades.
250. the rest of the calculation.
Okay, fine, no problem. So nobody else has any problem? We'll lose it to 250. We'll change it to 250, okay? It's a spreadsheet, so you can actually just, okay, you can look at the formula. You can, actually you should not copy the formula. You should construct it for yourself. Then it'll be better for you, okay? But you can cross-check, okay? Okay, so at Mehak's request, we have reduced the number of trades. The trading system is, she doesn't want to work that hard and do 500 trades in a year. She wants to do only 250 trades, okay? All right, so now 106K, average loss is 106K, can we say that? Probability of loss into average loss, or magnitude of loss, okay? Average win, average loss is same as magnitude of loss win. So probability of loss into average loss, probability of loss is 75%, average loss is 106K. Is that okay so far? Next is probability of win is what? 25%. So 1 minus 0.75 is 25%. We have that also. But we don't have the magnitude of win. Okay, so this requires us to make another assumption, and this introduces us to another concept, okay, which is this. I think we have not covered this yet. I think I've covered it before briefly, but let's put it in again once again in the calculation of system edge, okay, which is, I'll just put it here, okay. Okay, reward to risk ratio, again this can be both ex ante and ex post, okay. But target R3, when we talk about target R3 is always ex ante, okay. Target is always ex ante. That is kind of obvious, no? If I say target, my target is to make $5 million. That's obvious. Target is obviously a ex ante figure. It's a forecast. Okay. If you have already hit the target, you say I made $5 million. You don't use the word target. Okay. Or you say I achieved my target. So target is always that. So we are introducing. I have talked about this thing earlier. I'm just going to call it R3 because I don't want to keep saying this long expression reward to risk ratio. I'm just going to call it R3. Okay. I think I've used it before. I have given you an idea that when you are placing trades, when the system is asking you whether you want to buy or sell, let's say the Aussie dollar, you want to sell Aussie, okay, here it's asking you for, the system is going to ask you for some, first it's asking you for units. Let's say we don't want to waste our time. We want to enter, see this is the rate, it keeps on changing, okay. The system will ask you for a stop loss and a take profit, okay. So you're entering at 67.20, okay, and you can see this is not Aussie, actually we'll just look at it. So 67.20 you are entering, okay. This you can change the take profit to 69, and you can because you're selling, oh sorry, it can't be 69, we're selling, okay. So you're going short at 67, so let's make it 62, all right. And you got a stop loss of, let's say this is too tight, so let's make it 67.90, all right. So you have a 70-point stop loss and you have a huge take profit, okay. So are you following what we are doing here? This is just like your bracket order, except that I'm entering a market order, not a limit order. Typically in the TWS we have entered bracket orders with limit orders. That's what it allows. But we are planning to sell at the 60. We can actually make it simpler and allow you to look at Aussie, so you have a picture of what's going on. All right. So I'm actually projecting much lower levels. I don't know if you can see anything here. You can't really see anything. Little better. Okay, so what we are doing is we are going short Aussie, at the current market, you can see the market is they keep on adjusting the market price because I'm trying to enter a market order. Okay, so I'm going short at this price. I have a take profit at 62.10. Right now the market is 66.90, so the take profit is much lower. Okay, I'm expecting it to drop a lot, and I have a stop loss at 67.90, which is just around here. Okay, are you following this trade? Yeah. Okay, so when you're planning to do this trade, what we are discussing is,
So why have you put stop loss at 67.90? Because it will be more than the price now.
no, it is 67.90 in the market right now. I'm going short. See, the market right now is 67.19, 19. Let's say 67.20. Okay, and I'm going short over here, and I'm putting a stop over here. Yeah. Okay, and then my take profit is far below. Okay, because I'm expecting a big move down. Okay, all right, so here you can see, so far is everyone following? Okay, we are trying to discuss the concept of reward to risk ratio. That's the last time I'm going to say that. I'm going to say R3 only. Okay, R3, reward on top, risk on the bottom. So R3 in this case is, look at the take profit, $5.09. And stop loss is showing in the negative. Okay, you can just take it as with the absolute value of the loss. Okay, so it is 70 cents. Okay, 71 cents. Okay, so it is 5.09 or 509 cents. Okay, or 5.09 divided by 0.71. Reward to risk. Your profit is your reward, and the loss that you might experience is your risk. Right? Is everyone clear so far? It's not that complicated once you understand what it is. Okay, so we are going to just call this R3. Is this clear? Okay, so that's what it is. Okay, R3 on every trade is basically, you can conceive of, if you are using take profit orders. Okay, if that's the way you manage your last decision problem, which is how to exit at a profit, you can compute the R3. Okay. All right, so you can have an estimate of the R3. In this particular trade, you can see the R3 is 5.09 divided by 0.71. Is everyone clear so far? You have understood the concept? It's very, now that you have understood the concept once, next time you see the word reward to risk ratio, you will understand exactly what it means. Okay, I write it differently. Most of the time in the industry, people talk about risk reward ratio. Okay, but I write it in the way that you would discuss it in mathematics, because reward is on top. So you just, whenever you're discussing this concept with people in industry, you just have to make sure what is in the numerator and what is in the denominator, because the other guy should not be talking about something where your numerator is his denominator, then you will be arguing needlessly. First, make sure what is in the numerator, what is in the denominator, what are you talking about. Okay, is this clear? Okay, so we have defined the R3. Now, what was our original problem? The system edge. We are trying to figure out the system edge. Okay, so we have put the defined, look at the formula, average loss, which is magnitude of loss, times percentage loss. All this stuff is in your notes. Okay, you can just all this is in the document file which is shared with you, which you have access to. So this is all there in the note. The formula is all there in the notes. So average loss into percentage loss, that is probability of loss. Okay, plus, so we already went through this, plus average win into, we already knew this, 1 minus percentage loss, we already know. Okay, so we know 1 minus percentage loss because we know the percentage loss. So that's how we came up with percentage wins. So W is for wins. Okay, now average win we did not know, right? So average win happens, this is how you figure out the average win, because when you're planning out the parameters of your trading system, what you do is you also make a projection about the average reward, average R3 that you are going to experience. Okay, so every time if you do trades like what we just showed you, that 5.09 versus, we can do this here, we showed you a R3 of 5 in that Aussie trade that we were discussing, 5.09 divided by 0.71. Okay, you agree? That was showing you 5.09 by 0.71. So in this particular Aussie trade, the R3 was quite high. Okay, so it is, you can just write it into 7.17. Okay, so if you are able to achieve this if you think that you're, right now it's all an ex-ante analysis, okay, because you're planning your dollar risk per trade and other elements of the trading system before you start trading. If you think you can achieve 7.17 R3 overall on all your trades, okay, if you think, then in that case, let's say this is true. In that case, what is your, we are still trying to find out the average win. We know the average loss is equal to the dollar risk per trade. Remember, average loss we said is equal to the dollar risk per trade. Yes or no? We said average loss is equal to dollar risk per trade because we assume that all losing trades will lose the budgeted dollar risk per trade. Yes? We should not be saying dollars because sometimes you may compute, if you're trading Japanese equities, you are probably going to convert your risk capital into yen. So I'm just saying dollar is to just give you a sense of that it has to be in some currency. Okay? So let's say risk per trade. So therefore we have assumed that every losing trade is going to lose the budgeted risk per trade, which is the risk per trade figure we got here, 106k, right? So therefore average loss is equal to dollar risk per trade. Yes or no? I need to see more aggressive nodding because otherwise I'm not able to move on to the next part. Yes? Average loss is equal to risk per trade because we are assuming that every trade is going to lose the risk per trade, budgeted risk per trade. And this is the budgeted risk because we are doing an ex-ante analysis. A budget is an ex-ante analysis. After the period is over, it's no longer budget. It's just you see the variance against the budget, right? You've done your cost accounting, right? You guys have done it in FM1 or somewhere, cost accounting, or FM2, I don't know where exactly, or Manac 1 or Manac 2 or whatever. Okay. So yes, okay, every trade loses the budget. So therefore, average loss is equal to risk per trade. Yes. Okay. Now, what else do we need? We also have a figure for R3. It is 7.17. Okay. But instead of this, let's assume that this number is 3 because I put in 3 here. I don't want to put in another number. I can always put in 7.17. It's not a problem. But let's say, okay, we can put in 7.1. Everything will change. Okay. All right. So 7.17 we put in. Yes. So this is our projected R3. Because we are saying that on every trade we are going to realize this kind of R3. Yes? Okay. If our assumption is correct. So now based on the R3 and the average loss, can we figure out the average win?
So where did R3 come from? R3 value?
R3 value is that we just did this Aussie trade. We were looking at this Aussie trade. We don't have this. I can shut this now. Okay. We were looking at this Aussie trade where we were going short Aussie. It's around here now. And then stop loss take profit. We wanted to put the stop take profit at 62 something. And then we wanted to put at 90. So 67.90 short take profit. Why is it not calculating the take profit? It's showing everything as 0. There's some problem with the system. Everything is showing as 0. I don't know. For some reason, it's not calculating. Okay. Maybe it's got. Unit is not there. Good. See. Now you see 5.09 divided by 0.71. I took is 0.73. Right? Okay. Clear? This is where we got and then we said that on every trade we assume that we are going to, you have to make some assumption. That's why I kept it a little bit lower at 3 o'clock, okay, instead of 7.17, okay, because 3 is a lower number. But anyway, I think you should get gun for something very high, okay, like 3. So let's look at 7.17, doesn't matter, okay. Is this clear? You are making a projection on average, you will make R3 of 7.17. Is this clear? So can we from R3 and average loss, because we are still struggling to find average win. Can we write average win how should we write average win as a function of R3 and average loss? I've already given you the answer actually, almost. R3 divided by? No, I'm trying to compute average win. Based on your understanding of R3, can we write R3? We don't have time, so I can't afford to make this interactive. Can I write this or not? Or may I write this? Let's be more precise and more proper. So is it okay to write, what is R3? R3 is average win by average loss. What are we showing you here? Again, that thing has disappeared. Right. What is average? We define R3 as, see this take profit 5.1 USD means if the take profit is hit after the trade is executed, you will make $5.1. And if the stop loss is hit, you will lose 73 cents. So R3 is average win by average loss. R3 is in this case is win by loss, and we assume that this thing will prevail for all your trades. This dynamic will prevail for all your trades. So therefore your average win by average loss, R3 is equal to average win by average loss. Yes or no? Garotra, are you following? Yes? Okay. Mittal?
Yes, sir.
Are you following? Okay. So R3, is it fair to write R3 as equal to average win by average loss? That is what we mean by R3, right? So if that is the case, then I can write average win is equal to R3 into average loss.
Yes, sir.
Okay, so if I can write R3 if I can write this, then I can go back to my spreadsheet. I wanted to compute, I needed to find average win. You'll notice average win is actually a derived number, which I normally put in one of these gray figures. So average win is not a user input. How is average win defined now?
7.17.
Yeah, into average loss. Okay, you can see it is G13 into G11, and G13 is the R3. Is G13 is the R3? I don't know if you can read at the back. Okay, first be clear about what it is, okay? Maybe let's make it a little bit bigger so you can see a little bit better. Only on this part, okay? Okay, now see, can you see 11 and can you see G11 is average loss? G11 is average loss. You can see G13 is R3. G13 is R3. Yeah.
Average loss is calculated.
Average loss is calculated. We
You just have assumed that.
have set it equal to G16. Okay. This is because it takes the maximum run of losers from the start. Okay. So this is equal, again, this is also calculated. So if it's not in blue, it's not a user input basically. In general, if it's not in blue, it's not a user input. Okay. So I haven't put brown shading on every calculated number, but you can see that it is actually, you can answer your question by looking at the here. You can look at this and know what it is.
Can you show the
By looking at this here, you can see it.
calculation of average loss?
Average loss.
Average loss is calculated as dollar risk per trade. Okay, because what is this average loss? Average loss is here. This average loss is just setting equal to G16. And what is G16? Is dollar risk per trade. What is dollar risk per trade? It is G9 by G17 plus 1. What is G17? Maximum run of losers from the start, which we have assumed is 100% of the projected losing trades. If you go back under Mehak's less active trading system, total number of losing trades is 188.
The 500 actually If you were taking 500 days.
Okay, so we'll change it back. Now Mehak has been overruled by Parul and Shuchi. No, don't remember. Okay, no problem. You remember the numbers from. So anyway, that's why I wanted to keep it at 5. You're okay now?
Yes.
We have kept it. Okay. So now we have 375 losing trades. We assume that 100% because we don't want to complicate matters and we want to be ultra conservative. Okay. So we are assuming that all the losing trades will be stacked together as in the beginning as a run of losing trades, as a maximum number of losing trades. Yeah.
But I don't see when can I go.
Yeah. Carry on. Okay. So are you following now? So because this 375, the reason this cell exists is basically to give you the opportunity to define the percentage of losers in the maximum run of losing trades, which is you see this G2 here and the G5. What is G5 and G2 here is this G2. This we are not, for our purposes, we are keeping it as 100%. So the G2 may not even exist. This is clear? Okay, are you following so far? Okay, so 375 losers. All right. So what were we calculating? Average loss. Okay. So we are back to this 53K. Average loss is G16 and G16 is taking the G9. What is G9? G9 is our risk capital. You can still see it at the back, right? Here, G9 is our risk capital figure. Can you see that? So the dollar risk per trade is G9 divided by G17. What is G17? G75 is maximum run of losses in the maximum run of losers in the run of losses. Okay, which is equal here in our example to the total number of losers plus 1, because we don't want to blow out all of our risk capital, because then our risk manager will make us stop trading. Okay, so therefore we have to have that plus 1. Okay, so that we can justify continuing to trade. Are you following so far? So 53K is our average loss, because every trade loses the budgeted risk. Yes? Any question? Okay, every trade loses the budgeted risk. Now, can we say that average win is equal to average loss times R3? We have already seen that, because R3 is equal to average win by average loss. Okay, system R3. Okay, individual trade R3 is equal to total dollar in take profit divided by total dollar in loss. Okay, but system R3 is equal to average win by average loss. So therefore our average win is equal to R3 times average loss. Okay, so you can see that by having a high R3, your average loss is 53K, but your average win is about 381K. The higher the R3, the better it is. Okay, but then the higher the R3, the trade-off, it's not an easy decision, because the higher the R3, see here when we were making money if you had a targeted take profit system. Now right now we are discussing a system with a targeted take profit. If you had, let's say that it had not reached this particular amount, had already reached a targeted, if you have a low targeted R3, the chances of realizing it are better, but obviously the average win will be less. But if you have a more ambitious R3 figure, the chances of achieving it are less, but obviously every time you achieve, you're making more. So there's no easy decision, because there's a trade-off whichever way you go, right? So we'll keep that. Okay, so we got what we need for our system edge calculation. Did we get what we need? What do we need for system edge? Average loss times probability of loss, average win times probability of win. So we've got everything we need now. Okay, so we are going to calculate the system edge. Okay, here, look at the system edge figure. So I don't know if you can, I think you should be able to see the colors. G4 into minus of G11. G11 is the average loss. So we have to put the minus sign, because we normally compute the average loss as a absolute value. Okay, so therefore it depends on how you do it. If you do it with the minus, if you do the average win, if you do the average loss as a minus figure, then you don't have to put the additional minus here. Okay, you can just put plus. You can just put into. But if you do the average loss as an absolute figure, then you have to in the system edge calculation, in the expectation calculation, you have to put the minus sign. You have to be careful about that. Okay, so this is just the expectation calculation. So it is G4 into G11. This sheet is there with you, so you don't have to write down the formula. You can look at it later on. Okay, you have view right, so you can view all the formula. Just understand conceptually what is being done. It's nothing. This is what you call programming. This is why I said a spreadsheet like Excel, etc. Here we are using Google Sheets. It's a programming environment. This is also a form of programming. Okay, high-tech programmers will say this is a joke, it's not programming. But actually, in the eyes of the computer, this is also programming. You are just programming. This is the programming environment. Okay, here instead of writing this thing, that's where we get into syntax once again, which I explained to you the other day. Instead of putting this star, if I write multiply in English, then the system will not understand it. The syntax for multiplication is star. So I have to follow the syntax. You can't just write whatever word. Obviously, if I write multiplication, human beings will understand, but the computer will reject it. For the computer, you have to follow the syntax. Okay? Okay. So is this clear? Very simple. Nothing but we are taking G4. What is G4? G4 is percentage losers, which is probability of losses. G4. Probability of losses into magnitude of loss, which is average loss times minus of the average loss. Okay, the first term. The second term is probability of win, which is 1 minus probability, which is G10 times average win, which is average win is equal to R3 times average loss. Clear? Okay, it sounds very complicated, but all you're doing is nothing more than what you learned in school, weighted average. And then you graduated a little bit more, you learned about mathematical expectation, which is nothing but the weighted average, this time using the probabilities as the weights. Okay, and now you're learning another new term from trading systems lingo, which is the system edge. Somebody asked you what is the edge of your trading system. Okay, it's just nothing but this. Okay, which is the mathematical expectation of your trading system, and using the frequentist view of probability, we say that percentage losers projected is in the ex-ante edge. The percentage losers is equal to the probability of loss. Percentage winners is 1 minus that. Okay, so system edge, as you can see, again you should understand as it's written in your notes. Is everyone clear so far? Formula of system edge, this is nothing but the spreadsheet implementation. This is just the spreadsheet implementation of this. This is what I've written here. This is just a spreadsheet implementation of that. That's all. Nothing else. Okay. So you have the formula also in your notes. Actually, you should not even need the formula because you already know all this stuff. Okay. All right. So have we done this? Okay. So we got the system edge. Okay. Now, just like R3, system edge can also be ex ante or ex post. Ex ante is when you are planning your trading system, planning your trading activity before the beginning of the period. After the period, the figures will probably differ from what you projected, but whatever you take the actual realized values at the end of your trading year, you take actual how many trades you lost on, what is the percentage of actual losses. That is the ex post trading edge. Okay, so when you're doing your planning, normally you're working with the ex ante edge. Okay, all right. Okay, and then obviously you want the ex ante to be more conservative than the actual ex post. You want the ex ante calculation to be more conservative than the ex post realized values. Okay, so we have understood reward to risk ratio also. Okay, something else you have to understand. Okay, I think pyramiding positions we have already covered. Okay, there is another important calculation, a couple of other important calculations that we should cover in this course itself. Okay, now let's see. Okay, one more thing I have to warn you about. Okay, this I'm not going to spend much time on. Okay, which is that so far we have taken very simple examples of calculations of losses. Okay, we took most of our loss calculations were done in the case of taking the example of trading in stocks. okay, where you're trading in shares of TCS and the P&L is coming out either in dollars or in rupees. Okay, so it's very simple, okay, because your risk capital is also in dollars. In this case, we looked at TCS price in rupees and we assumed the rupees are actually equal to dollars and we made some wrong assumptions. But it's very simple because your P&L is in dollars and your risk capital is also in dollars. So you have to be very, the point I'm trying to illustrate here is that P&L is when the P&L is in currency or asset different from asset in which risk capital amount is defined. This is have to be very careful. You have to understand, if you are being given money to manage in Japan, if you're living in Tokyo, Japanese investors giving you money to invest in Japanese equities, that risk capital amount is going to be defined in yen. But if the same Japanese investor has given you a risk capital amount defined in yen, and then he's told you to manage US equities, you're trading in shares of Microsoft, Amazon, Facebook, etc. Now there your P&L is being generated in dollars, okay, but your risk capital is in yen. So every time you do a calculation like this, for instance, you have to be careful about this. What were the calculations we were doing? Remember how we are connecting position size to risk capital? We said that you are losing if you go long TCS at 22.35 and you stop it out at 22.07, you are losing $28 per share, okay? And then you can afford to lose only $106,000. So therefore the position size that you can afford to buy is 106,000 divided by 28, okay? This is because your P&L is this P&L here, this risk capital allocation, because the dollar risk per trade is coming from the risk capital allocation, which is in like it could be in Japanese yen. I'm giving you example here, it's in US dollars, okay, and your P&L is also in US dollars, so there you can make this calculation. But if the situation is different, if we take dollar Canada, okay, if you take the example of dollar Canada, there could be all kinds of other things that you have to estimate, okay, which is, we'll just take the example of dollar Canada. If you're trading, something that you have to understand, okay, which is when you buy sugar in India, you go to the Ghazipur Mandi and you become a trader and you're trading 10 quintals of sugar, you buy 10 quintals at 100 rupees per kilo and you sell 10 quintals at 120 rupees per kilo. You have made a profit, okay, in 10 rupees per kilo. This profit is in sugar or in rupees? Rupees, okay. So you can always go back to this example, think of yourself like this, and go back to if you ever get confused. But the rule is P&L is always generated. P&L means when you do a trade, whatever profit and loss, okay. P&L is always generated in, we should write in the terms asset, but I'm going to just ignore good English right now, we don't have time. P&L is always generated in the terms asset. We have to write it here because you remember base asset, terms asset. So the general rule is that the P&L is always generated in the terms asset in any market. If you ever forget the rule, you go back to trading sugar in Ghazipur and you find out that your profit is not in sugar but is in rupees. And then you can work it backward that when you're trading sugar, your terms asset is Indian rupees. And that's why so that proves that the P&L is always generated in the terms asset, no matter where you are, what market you're trading, okay. So when you're trading dollar Canada, let's take one more example. Let's shut this thing now. Let's take the example of dollar Canada. I hope it's here. Yeah, dollar Canada, okay. So let's say I want to buy dollar Canada, okay. Let's say I want to buy 100 units of dollar Canada and we can change okay, so I want to buy 100 units of dollar Canada, alright, which is I want to buy at the market 33.16, and I'm just going to take a stop loss example at the moment, okay. So it is showing you what stop loss of, let's say I'm using a very wide stop loss, okay. So can you see the stop loss of 2.37? They are showing you the profit in 2.37 US dollars, but actually this is not how the profit will be calculated, okay. They are actually doing a conversion in between which they are not showing you. What will happen when you buy dollar Canada at 133.15 and you stop at 1.3? Let's do this calculation. Okay. What will happen is 1.3 is your exit, and what did we say? 1.3315 is your entry, let's say. Okay. And these are your dollar Canada exchange rates. In dollar Canada, what is the terms asset? Canada is the terms asset, because in the currency markets we always by convention show the dollars, the base asset first in the currency markets. Okay, so in dollar Canada the terms asset is Canadian dollars. Okay, so I enter at 1.3315 and I exit at, and I buy $100. Okay, so how much is my loss, projected loss? 100 into 1, I should put the exit first, so I'll get a negative number. The bracket there, yeah, okay. So I'm losing $3.15. Okay, but you notice these guys were showing us, I closed it actually. I shouldn't have closed it. Should I put 3315 here? Yeah, 3315 here. Let's keep. This is acting a little fun. Okay, so let me just put it as 1.3. Yeah, $2.37. Okay, why is this discrepancy? Because this is in which currency? USD. And what did we tell you? PNL is always in the terms asset. So this 3.15 is in which currency? Canadian dollars, because Canadian dollars is a terms asset. Okay. Now, when I exit the position and realize my loss of 3.1715 Canadian dollars, at that time, so I need to convert, because my risk capital is in US dollars. Suppose my investors given me risk capital in US dollars. I am trying to calculate Canadian dollar position size. So when I look at risk per trade, because here I looked at risk per, maximum risk I can take is $106,000. This PNL is also in dollars. This was dollars per share. Okay, it was not Japanese yen per share. So I was able to make a direct comparison. So you have to go through an additional step when the PNL is in a currency which is other than the currency in which your risk capital is defined. Are you following what I'm saying? So here you're generating PNL in Canadian dollars, dollar Canada. The PNL is coming out in Canadian dollars, the raw PNL. You have to convert this raw PNL into the currency in which your risk capital has been defined, which is US dollars. So we have to convert the loss into a US dollar loss. So at the time that these guys are using a slightly wrong methodology for this, but we should have a reasonably close figure. So what you have to do is 3.15 Canadian dollars is what you have lost. Okay. So 3.15 Canadian dollars is equal to how many US dollars? Should I divide by, should I multiply, divide what? Okay, we don't have time to do all this discussion, but I will tell you, if dollar Canada is 1.331, if dollar Canada is trading at this, that means what? 1.33 US dollars per Canadian dollar, or 1.3? Does this mean 1.3315 US dollars per Canadian dollar? Yeah. 1 US dollar is equal to 1.33 Canadian dollar, 1.33 whatever, 15 Canadian dollars. Is that right?
Yes.
Okay. So now therefore, when you see these rates, you know this is Canadian dollars per US dollar. These rates are Canadian dollars per, just like our dollar rupee, 72 rupees means rupees per US dollar. This is 1.31 Canadian dollars per US dollar. Yes? So the Canadian dollar is called the loonie. Okay, just for your, just like it's called the, we don't have the, it's a loonie is a bird which is there, the picture of the bird is there on the $1 Canadian coin. So the Canadian dollar is sometimes called the loonie. Okay, this is just fun. This is for trivia. Okay, this will not come in your exam. Don't worry. Who is the loonie? Okay, right. So we have to convert. So this is what these rates are. One second. These rates are Canadian dollars per US dollar. I lost 3.15 Canadian dollars. So what is the US dollar value of my loss? Divided by 1.3315 or 1.3? divided by, now I think we'll go with Mittal's answer because we have to divide, not multiply. Okay, we have to divide. Okay, because the dollar is higher than parity. Okay, so $1 is worth more than one Canadian dollar. So we have to divide to get a dollar amount. The dollar amount will be smaller. The USD amount will be smaller than the Canadian amount. So we have to divide. The question is to divide by 1.3 or 1.3315. System is very slow. I should not have loaded this. I don't know why the system is so slow. Okay, we got it. Okay, 1.3 is somewhere here and 1.3315 is somewhere here. Okay, alright, 1.3 is somewhere here, 1.3315 is somewhere here. So when I get stopped out of my trade and lose 3.15, is the market over here or is it over here? It's below. It's at 1.3. So the dollar value at the time I realize the loss should be taken into account. Okay, these guys are using a slightly wrong procedure. So I should divide it by the exit at loss price. This 1.3 is my exit at loss price. Is that right or not? This is my stop loss. This is my exit at loss price. So I should divide this by 1.3, not by 1.3315, because the dollar value of the loss at the time I realize the loss. Because the way it works is that you realize a loss of 2.42, you realize a loss of 3.15 Canadian dollars. The Canadian dollar broker asks you to pay $3.15 in Canadian dollars. You have to instantly get that money from your US investor, and at that point the exchange rate is not 1.3315, it's 1.3. So the true dollar value of your loss at the time of the loss is equal to should be converted at the exit price at loss level. Are you following? Yes? Okay, so it's 2.42. These guys have a slightly different figure because they actually use this figure. They use the current rate, which is the wrong methodology. Okay, but anyway, it's not a huge difference because our position size is very small. Okay, all right. Okay, so this is something that you have to be very careful about, because you have to be conscious about the currency in which your risk capital is denominated, and you have to, if you are trading in some other market where you're generating, like you're trading sterling yen. If you're trading sterling yen, in which currency is your PNL? All the buy, sell, loss, profit, PNL is being generated in? Yeah, what is that? Yen. So if you have dollar risk capital and you're trading sterling yen, you have to convert every loss profit projection into a dollar amount by converting at the exit rate. Now you have a different exit rate here, because here the dollar is not even featured in this currency market here. So you have to separately have a figure for the dollar yen rate. Okay, you have to make an assumption about the average dollar yen rate. So the point I'm trying to emphasize is you have to be conscious. You can't compare like apple and orange. Okay, so you can't add yen amounts and Aussie amounts and add it together and have one total. Okay, so you have to be conscious of the currency of the denomination. Okay, of your risk capital amount. Okay, all right. So we'll cover one more point. Since Garvid is not here, we can let the class run a little bit longer, and Sukriti is also not here, so we don't have anybody to force us to finish early. Okay, so here I've given you all kinds of calculations. You can revise that, you can look at that on your own. Okay, which is basically all this stuff is we have already covered all this stuff. Okay, this is what is the risk per position size, POS is position size into absolute of exit price minus entry price. These are all formulae which I have given you for your own reference, okay, for studying. But we have already covered all this. This is all common sense stuff which we have already covered. You can study it on your own. Okay, so this is a very important point, that you have to understand which currency your PNL is being generated in, and which asset in general terms, we don't want to talk only about currencies, which asset in general terms your P&L is being generated in, and which asset is your risk capital defined in. Okay, usually these will both be in currencies, okay, because whenever you trade you generate asset, P&L is in some currency or the other, okay, and risk capital is also in some currency or the other, but we still want to use the general term of assets, okay. Alright, so these are points I've given you, which I gave you the example, okay, you can study it on your own, we have already discussed it, okay. Pyramiding we have already defined that it should be on a gross basis or not on a net basis. This is the part that is mentioned. We already discussed this. Okay. Last thing we have to understand. Okay. Very important calculation. We should cover it as part of our module here. We still have a little bit of time. It will not take very much time. Okay. Now try to understand what we are trying to do here. Okay. I think we can just move this here. I think we have already done this. We'll just move it here to avoid distracting us. We are trying to answer this question. Okay. Suppose your investor has told you that I want you to achieve a certain, many investors actually, especially money managers, I think this is kind of stupid, but it happens in the real world. Money managers, you'll see, they'll say, we are targeting a 15% return on capital, so return on invested capital, okay. So I think it's stupid, because how do you know? I mean, are you telling me that if suppose you're targeting a 15% return, you understand what is meant by return on invested capital, right? Okay, your invested capital is very simple. Your invested capital is 100 million. Okay. Now, if you are, if you are talking about, what is the target? Okay. Okay. So now this is actually the return that we want, I think. I've given a mistake here. I've made a mistake here. But anyway, the point is, let's understand, if your invested capital is $100 million, okay, and this is actually the return that you want, okay. Let's try and put it somewhere. Let's try and put it here. Okay. So let's say I want a 20% return, okay. If your investor wants a 20% return, okay, that means you have to generate a profit of $100 million into 20%, right? You have to generate a profit of $20 million, right? If I change this to say 29%, okay, then you have to generate a profit of $29 million. Is this clear? Usually there's a discussion that happens like this, but it's kind of stupid because you don't have any control over it, but still this is a discussion that happens. So one of the legitimate questions that arises, that if I have to achieve a 29% return on capital, okay, why, I thought I made this thing here, okay, okay. So suppose I have to achieve this return on capital, okay, then I have to achieve a total return of 29 million. This is clear? Okay, I'm going to take a little bit of time because I want to finish up. We still have 2 minutes. Okay, so is this the first step is clear? Investor tells you that I need a 29% return on capital. That means you have to make 29 million. Okay, so before this we have to clarify one more point actually from the system edge calculation. So if you look at the system edge, okay, if you look at the system edge, and if you look at the total number of losing trades, 375, there's a concept of gross loss, okay, or total losses, okay. If you look at total losses, you can calculate total losses by, what have we done in total losses? We are saying total losses equal to number of losing trades into average loss. Is it fair? Total losses is equal to, now you can see it here in the formula, you don't have to write it down. Is it okay to say total losses is equal to number of losing trades into average loss? Yes? Right? Just listen to me, don't focus on writing, because this formula is available to you, okay? So number of losing trades into average loss, okay? Now, if this is total losses, then total profits, okay? Total profits is equal to number of winning trades into average win, okay? And your estimated gross profit. The gross profit I'm using in the sense of the way we use it on the P&L. So the gross profits is equal to total profits minus total losses. This is just like sales revenue minus cost of sales. Gross profit is equal to sales revenue minus cost of sales. You remember from your balance sheet, from your financial statement analysis. Sales revenue minus cost of sales is equal to cost of goods sold, okay, is equal to gross profit. Yes or no? Yes. Similarly, total losses is equal to the same concept as cost of goods sold, okay, and revenues is equal to profits, okay. So total profits minus total losses is gross profits. We can see that here. It's nothing but basically, okay, that is a different calculation of gross profit, but essentially it's basically this. You can see this, okay. You can have a corresponding calculation here. If you take total profits minus total losses, you will get the same figure, 27.7. Is this clear? So estimated gross profit is equal to total losses minus total profits minus total losses, okay. Now the other way to arrive at the gross profit is also, what is the meaning of system edge? System edge is basically the average outcome. Remember we said expectation is equal to average probability weighted average outcome, okay. So here system edge is probability weighted average outcome of the trading system. So on average you make 55K. On average you make 55K. How many trades are you doing? 500 trades. Over 500 trades on average you are making 55K. Notice that 500 is here in G3, okay. So therefore another way to write the system edge is another way to write the estimated gross profit is system edge into the total number of trades here. Can you see that? Total number of trades into system edge. Total number of trades into system edge is equal to, are you following? Total number of trades into system edge is equal to the total profit. Clear? G3 you can't see here. G3 is equal to the total number of trades. Here. Now you can see. Now you can't see. Now you can see. Yeah, now you can see. G3 is equal to total number of trades, and G3 into system edge is equal to your estimated gross profit. Is this clear? Yes? Everybody hungry? Okay. So I wanted to cover one more topic actually, but we are already behind time, so we'll have to just let it go. Okay, so we'll cover it in the next course. So that's how your syllabus is going to be. It's going to be one. I don't think that that's the way I visualize the teaching of finances. The body of material is so vast, and it's all common actually to all these treasury management, financial management. Everything is common. Okay, so you have understood this much. Now, what is the last point? 1 minute. Let's just. We are just 3 minutes over time. One sec. Sit down. Okay. We did not manage to we did not manage to cover this topic. Okay, R3 required to have. I think we can cover it. Okay, guys, give me 5 minutes. I'll cover it for you. Okay, then you can play back the video. 1 minute. One minute. One sec. We'll cover it for you. So you've understood this point, that how this is, and you can see it yourself later on by looking at what is the meaning of system edge. Probability weighted average outcome. It is the average outcome per trade times number of trades is total outcome. Total outcome is 27 million. Okay, 27.7 million. That is the same as total losses, total profits minus total losses. You can come at it in two ways. Okay, so now what we have is basically this. So I'm just going to take like 10 minutes extra, and then yeah,
5 minutes.
1 minute. Just hold 1 second. We'll cover one topic. I think you can handle it. Don't worry. Okay. You have no classes after lunch.
No.
Okay. 1 minute. One day you will eat a little less. Okay. 1 minute. Be quiet. We'll finish this one topic. Okay. So this is clear now. Okay. So we go back now to our system edge is average outcome. System edge into total number of trades is equal to gross profit. Gross profit is also equal to total profits minus total losses. Okay. All right. So therefore, now we come back to this question. Investor wants you to return 29%. Investor wants you to return 29%. Okay. Then what we'll do is, I think, okay, fine. Let's not make it, because this is an important concept. We'll cover it in the next. We'll cover it in the next course. So I think I'll let you guys go now. And so this basically, so we'll have this as part of your syllabus. Okay. So whatever we have covered until now is part of your syllabus. But we have covered a lot of very technical material in the last few sessions, especially a lot of calculations. So please make sure you go through the videos and understand those calculations. Okay. So we have some of the formulae here. Most of the formulae are already here. Okay. Even this we have, which we can, but we'll do it later on. Okay, guys, any technical questions? The rest of you can go. So class is dismissed. So I've only taken 6 minutes extra. Okay, that's equal to 1 hamburger. Like 1 hamburger for each student. Okay. So anybody has a technical question, not relating to attendance and all that, but anybody has a technical question? Yes, then I won't close the video. Then I'll make sure it goes into the video. So please remember that video means everything that is discussed, even something that is discussed with Mehak at the end of the class. If it's in the video, then it's part of your syllabus. Okay. So now what I'll do is I'll explain that last concept to her only, and then I'll put it in the syllabus. Okay. Yes. Go ahead. Go ahead.
Sir, where is this value written in the calc file? When we multiply the probabilities also, and
1 minute. Which one are you talking about?
when we the system edge, when we calculate the.
Are you talking about the doc or you're talking about the sheet?
No, the sheet. This one, the calc file.
Yeah, the system edge. The system edge is here.
Where we multiply the probabilities and the
Outcomes.
yeah, and the magnitude of the probability. So where is that figure?
Here, 15, G15. The row is G15.
System edge.
System edge. It's all labeled properly.
So we calculated it manually and it came out to be this.
No, then you must have made a mistake.
Because of the
No, what is it? Did you take these figures
79%
into
into
average loss is 53191
plus 25%
into
Acha, okay. By mistake I added
into average win?
38138.
No, you can't add. No, this has to be multiply. You have to have it's summation PIXI. So every time you have to do PIXI, P1x1 plus P2x2 plus P3x3. In this case, we have only 2. Right? Yeah. Technical question.
Sir, what's the difference between the limit order and the take profit?
So the take profit order is basically what we would call slang. Okay. So take profit order is one that is used to capture profits. Okay. And so that is essentially in the form of a limit order. Okay.
So take profit is a form of limit order.
Yeah, it's a type of limit order. So limit orders can be used either to enter positions or to take profit on positions. Okay. So if you see here, these guys don't use very good. They don't have very good terminology. These guys, their terminology is not good. So you refer to the TWS. Okay, and see your notes on definition of limit orders. Okay. So limit order basically is a type of order where the way you have to remember limit order is that it will always execute. It will lead to a transaction, buy or sell, at a price more favorable than the current market. Okay, and then so therefore basically we already have limit orders here, I think, right? It's already given here somewhere. Yeah, limit orders. Okay, so a take profit is one type of limit order, but remember that take profit is a kind of a slang. We don't use it in the system. The system does not understand take profits. It understands only limit orders, stop orders. Okay, so take profit, you are using it because you are using the limit order to take profit. So take profit is like stop loss. It is kind of like slang language which people use, which intended to show that it is meant to stop the loss and take the profit and things like that. right? So you can think of take profit as one type of limit order.
If you're asking an exam the sheet, like various calculations you have to do, so you will be providing the exchange rates. Like,
Yeah, whatever, if you are asked to do any calculation, then whatever information you need to do the calculation will be there.
because R3 you calculate through a software like
So that's why I asked you to bring a calculator. No? These are not like, there's no log or something
only simple division.
exponential or this and that involved here. These are all simple plus
Such
minus.
type of question can be expected.
Anything can be expected. Anything that is taught can be expected. Any type of, your concepts have to be clear. But I've told you already to bring your calculators, because you will be required to do some calculation or the other. Okay, you may be required to do some calculation. So therefore, any calculation. But these are all these calculations which you see. They look very complex, but they're actually not. It's just basic algebra. If you see the material that I was trying to cover.
Can you please provide the right to download the file? We can practice.
You can actually, no, I won't let you give, I want you to write the formula on your own. Like she has made a mistake just in, even though it's a simple formula, you have access to view this file, you can check the formula. You should create your own spreadsheet, not to download this. You should create your own spreadsheet and then you can cross check against this. You have access to the formula, you can cross check the formula. She has made a mistake just by writing, instead of writing multiply, she has written plus. So unless you do it yourself, you have to understand the concept and do it yourself, right? So although they look very complicated, they're actually quite simple. If you see even what I was trying to do last at the end, which I did not have time, okay, which is what is the R3 required to achieve the target return on investment or invested capital. In fact, I'm going to add it to the syllabus while explaining it now with those of you who are not hungry. Okay, so what are we going to do? What we have to do essentially is look at this. That essentially what we have to look at is, suppose you have to worry about the investor has asked you to make 29% return on capital, which means return on invested capital. Invested capital 100 million, so you have to make 29 million profit. That means your system edge, you already are going to make 500 trades. Now what is the total profit? We know already from here that the total profit, estimated gross profit, is equal to system edge times number of trades. This is equal, gross profit is equal to system edge times number of trades. Why is it showing there? Can you see that? The gross profit, which is 29 million you have to target, is equal to system edge times number of trades, which means system edge times number of trades has to be equal to 29 million. Number of trades is known, so system edge has to be 29 million by, so system edge here has to be 29 million. Are you following so far? Divided by number of trades, because system edge into number of trades is equal to 29, must be equal to 29 million. Okay, so therefore system edge, 29 million divided by number of trades must be equal to the system edge. So this must be your system edge. Okay, so what else do you know? Okay, let's okay, this must be that's why I'm writing it in the same row. Okay, so this has to be your system edge. Okay, now what is system edge? Now let's go back to this, and this is all the point I'm trying to illustrate is that although it looks very complicated, because there are actually many sub steps, so to be very careful. You miss out a minus sign, like she put plus instead of multiply, you'll make a mistake. But actually there is no, like, we are not using partial differential equations and heat diffusion equations from physics and all this. So it's actually just basic algebra, but you have to be able to do it stepwise and be very careful. Like currency, what currency is the PNL coming out in, what currency is the risk capital denominated in. You can't compare yen and amount and Aussie amount. Okay, so you have to be, what is system edge? System edge equal to minus average loss into percentage loss plus this. Okay, 1 minus this, or we can rewrite this, because see, what we don't know here, we know that system edge must be equal to 58,000. Okay, so what did we know? We know that percentage losers, we know the percentage we know the percentage losers, we know the percentage winners. Okay, 25%, where is it? Somewhere here. Anyway, 25%, yeah. We know that percentage losers, we know percentage winners. We know the average loss because we have already computed it from this 53,000. Okay, What we don't know is so out of system edge, we only don't know the average win. Okay. So we have to write average win, and now we are doing again this is all modeling. Okay. Okay. So you have to model average win as a function of the other parameters in the system edge equation. Okay. So this is basic. I don't know. This is class 12 or class 10 algebra. Okay. So you have to just move around the terms. So this is equal to SE plus this term is equal to average win times this. Okay. It's all there in your notes. Okay. Or this is equal, that means, or at the way, average win is equal to SE plus average loss times percentage loss divided by 1 minus percentage loss. Okay. So I don't know why I've written this here, but we can move this away. So what we need to know is basically, because see, remember what is the question? The question, the problem, the decision problem is the investor is demanding a 29% return on invested capital, which means I have to return 29 million profits for him, gross profit. Okay, total profit minus total losses. That means system edge times total number of trades. Then my problem is I already know the number of trades, the percentage losers, therefore percentage winners. I know my average loss,
You know total
but
loss, but you don't know how to calculate.
I don't know the average win. So my problem is, what R3 should I shoot for? What R3 should I shoot for if I have to meet the investor's expectation? Are you following?
Yes.
Okay. So what R3 do I have to shoot for? So this has to be now therefore written as basically, 1 minute. So what R3 is, do I have to shoot for? This later on I will divide it. First I need the average. So eventually I will have to write the R3 as average win by average loss. Average loss I already know. Now average win I have to write like this. Now I've already written out the equation. This is more important. Now you have to put this into the spreadsheet. You have to enter this formula into the spreadsheet. So let's do it. Okay. So we are going to write system edge plus average loss into percentage loss. So the system edge we take, let's say if we take this equal to the system edge, we set it up here. So the first term is, so that everybody knows that everybody can see what's going on. The recording is still going on, I hope. Yeah, okay. So are you following so far what we are doing? Okay. So now we are going to write the two terms separately. We'll write the divisor separately so that there's no error. It's always better to split it up so that when you're programming into a spreadsheet, better to split it up in separate cells so you can troubleshoot better. Okay. So first we write system edge. Then we write in another row, this is the system edge, right? This in another row we have to write system edge, what do we have to write? System edge plus average loss into percentage loss. Okay. So let's write this into or plus, what is it?
So into.
Okay, into average loss into
SE plus
C plus
yeah, 1 minute. See, I also don't remember what I've written. Okay, I'm also not SE plus. Okay, SE plus. That's why I'm thinking. Okay, SE plus into average loss into percentage loss. Okay. Okay, so into this should be this, right? So this is one term. Okay. Now we have to divide by 1 minus percentage loss. So what we'll do is we will divide this by 25%. 1 minus 7 should be.
and minus 0.7 करेगी ना percentage loss minus कर रहे हैं ना
Divide by 1 minus percentage loss is 25%. Okay, so let's see if our answer is correct. That also we have to check. So we are getting 391. Okay, this is our, what are we getting? This, what is this? This is average win. Okay, this is average win. Okay, so now this we have to divide by average loss. Okay, by $53,000 risk per trade. Okay, how is this coming out?
so you just entered that
Oh, okay. I didn't divide. No, this divide by C. This is why you guys can also help out by being attentive. Like Parul was pointing out repeatedly that I was missing out the unit. Is it okay now?
yes sir
Okay, 7.36. Okay, so if this is 7.36 is our, then let's calculate the system edge once again. Let's cross check now. Okay, so it's 7.36. If this is our, once again, let's recalculate system edge. So let's maybe make this a little bit smaller and make this a little bit smaller, and so we can bring this row in a little bit. Okay, so let's once again, against the system edge row, let's write this. Okay, so what is going to be our system edge? It is going to be let's put it in brackets, percentage loss into minus dollar risk per trade. Okay, close bracket, plus
25.
plus we have to put 25%. Okay, 25% into, we have to put another bracket and put 7.36 multiplied by average dollar risk per trade. Did everybody understand this step? Okay, everyone follows this step. Okay, because actually what I have to write here is average win. So I'm writing the average win as R3 multiplied by average loss. Yes, everyone followed this. Did I do it correctly also? Because here you have to be very careful. When this is exactly like why I said this is a programming environment. When you're programming also, you have to be very careful. That's why you have to use comments and stuff when you learn to code in Python or C++. You have to use comments so that later on, because you have to assume that you're going to make errors, you will have to go and troubleshoot. So you program in such a way that you can have a good time troubleshooting. I mean, you don't have such a hard time troubleshooting. So have I done it correctly?
Yes.
That average win is shown as L11, which is your R3, right? Times the dollar risk per trade, which is R3 times average loss is equal to average profit. Okay, average win times probability of win. Okay, so I need another bracket here. Okay, and now it should be, we don't need any more brackets, right? Is this correct? I don't think we need any more brackets. So the system edge is okay. So then, and that means we have got 10 out of 10. Okay, so once more let's calculate and see. 58,000 is my system edge.
Yes, sir.
And so what is my gross profit, estimated gross profit system edge into? Gross profit is defined in the sense of the way we use it in the P&L statement. Revenues minus cost of sales. Okay, so total profits basically. Okay, estimated gross profits is what we have written, is equal to what? System edge times. I am now trying to make sure that I have earned 29 million. Okay, you are saying that I should use, you are saying that my answer to my question, actually the question that we were trying to answer was,
Is into total number of trades.
the question that we were trying to answer, this is the holy grail for us basically. We were trying to answer what should be my R3. Everything else is known to me. What should be my R3 if the investor is demanding a 29% return on invested capital? Invested capital is $100 million, so I have to make $29 million. Now I know everything else, so if I make $29 million, that means I have to make a estimated gross profit of $29 million, which we have defined as total profits minus total losses. Okay, now so this is the holy grail I was looking for. Okay, now I'm just cross checking. So my question was, just to revise, what is another way of arriving at the estimated gross profit? One is to take total profits, subtract total losses. Another way to come at the estimated gross profit using system edge is what?
Estimated number of trades. 500.
System edge into total number of trades. That's another way of arriving at estimated gross profit. So that's what I was testing. Okay. So now I'm going to take this system edge and multiply by the total number of trades. Are we getting 29 million? Good. So we have all become tigers. Tigers and tigresses. So we can all go to the jungle. Okay. Then we can become Shami Kapoor fans. No, everybody will say. Okay. All right. Okay. Is this clear now? Kanika, were you following or you eating lunch? Or you can eat lunch and follow also at the same time. Yes?
Yes.
Okay. So the video can be watched. Everything is recorded on the video. Every step is shown. Now even if I have to explain it again, I'm not going to explain anything different. It's going to be the same thing. So you have to replay the video. This is how you learn. This is why I'm forcing you guys to watch the videos, because this is I've discovered also myself while studying that this is the best way to learn. If you really want to learn and internalize it forever in your brain, okay, this is how you learn. You look at a video whenever you're learning something technical. Okay, you look at the video, watch it for 4-5 minutes. Some concepts have been taught, then you pause it, then you revise mentally. Okay, what have I understood? Then maybe you make your own notes. Okay, if you do that way, it's more time consuming, yes, but then you've achieved something useful in the sense that is completely embedded in your brain. Now you will never forget it. Okay, but otherwise what is happening in most of the cases is you guys are studying some concepts and then you're forgetting everything by the next semester. Even the stuff that is taught in the previous semester, in the previous class, you guys are forgetting, because there are two problems. One is you're not paying attention, and then you are not revising. Okay, so now you can see that. Let's see what happens if the cable trade makes money. I was showing you that this is. Remember what we discussed yesterday? You remember what we discussed, that you look at the long-term system. The long-term system was bearish, but the short-term system, when we looked at it, was bullish. And we said if it breaks this, then the short-term bullishness will be neutralized. That's what happened after Boris Johnson suspended Parliament and the Queen agreed to it. The cable dropped, okay, and it broke this support. So now actually I've gone short immediately when I sold one lot here and I left one order. Now let's see. Now what has happened from a system trader's point of view, now both the systems are aligned. Long-term system and short-term system are both bearish. So now we'll have to see what happens. Whether actually, now my projection is that eventually this will not cross this level anymore. So this is where my stop is. Okay, this will not cross this level, and it will eventually go far below this, below 1.2. Now let's see what happens. You can monitor cable on your own. You have the charts and stuff. Okay, guys. So you have a lot of material, but we have covered a lot of useful stuff which you will not find in any finance textbook. Okay, but these are all very important things for managing risk books. Okay, especially when you're managing it on the active risk book side, if you're in asset management. Okay, because this is how you control risk. Okay, so you can see, you should notice that these are actually very these look very complicated, but actually the maths is just high school algebra, nothing more. But you have to be very careful going step by step. Okay, and you have to be mindful of all the nuances, like risk capital is in dollars, I'm generating PNL in yen. I can't, when I'm doing my position sizing, that becomes important. Remember, when you're doing position sizing, you have to look at the binding constraint is your dollar amount that you can lose, not the yen amount. Okay, so you have to make those comparisons. Okay, all right, guys. So good. I'm also hungry. Let's stop it here. So any other questions? Any other? You have what?
Download right for the
No, I just clarified to Piyush that I'm not deliberately not giving you download rights, because I want you guys to work. You have view rights. You can see all the formulae. So I want you to create your own spreadsheet, not download this. So you have to create your own spreadsheet, then you can cross check against this. You have to create your own spreadsheet.
So this is out for stop order and limit order.
Okay, good that I have not stopped the video. Yeah, okay, go ahead.
Limit order is something, for example, if we are buying and we are not sure of the market movement is whether it's going up or down, so limit order will help to get a favorable price that is less than the market price, right?
Yeah, okay, less than the current market price.
Stop order, for example, if we are buying, at the time of buying, we can also put the stop order. So it will make sure that we are buying more than market price, or what?
Yeah, if you're buying, essentially a stop order will ensure that you end up transacting at a price less favorable than the current market.
Yes,
so like for instance here, if you look at this example of cable,
yes,
okay, we can pop out the chart. We can look at this example of cable. Okay, if you are bullish, let's say,
yes, sir.
if you are bullish but you think you really want to buy, you're not really bullish over here, but you're a breakout trader,
Yes, sir.
you want to buy only if it goes and makes a new new high. Okay?
Okay.
So you will place a buy stop order at this 2309 level, roughly wherever the high
So
is.
that I'm
Okay?
buying more than market price.
You're not buying more than the market price. You have to be very precise in your use of words.
Okay.
You are buying at a price less favorable than the current market price.
Current market price. Okay.
Okay?
So then, sir, in that.
And in the case of a limit order, if you were bullish, but you don't want to buy right here because you can feel, you have to understand, all orders are based on views.
Yes, sir.
Or what type of order you use, as I mentioned before,
Yes, sir.
is a function of what is the precise view you have about the market. And so one of the advantages of using technicals, of being trained in technical analysis, is it teaches you that you can form very precise views about the market. Very, very precise views. So you can have a view that, okay, overall I think cable is going up, okay, but I don't want to buy it here at 2180. I think it's going to come down to around 2080 and then I'll buy it there.
Okay. That's the
So then you place a limit buy because, well, first you say that I place a buy order. And is it a limit order or a stop order? Well, it has to be a limit order because you are intending to buy at a price more favorable than the current. You are intending to transact. Let's use general language. So you are intending to transact at a price more favorable than the current market because buying lower is better than buying higher. Is this clear now? Okay. So the operative things you have to remember is stop order, transacting at, so if you just remember some keywords: stop order, transacting at price less favorable than current market. Limit order is like almost the opposite, transacting at price more favorable than current market.
So for in that example, that entry price was given 1.3315. So why did it put the stop loss at 1.30 for the US and the
For the Canada,
Yes,
okay.
sir.
So let's look at the Canadian dollar example that we looked at. We use a longer term chart. Okay. So let's look at this, okay? Make it even bigger, okay? So the 1.30 is roughly here,
Yes, sir.
and this is the current market.
Yes,
So
sir.
we were looking at a situation, here I was trying to demonstrate
Okay.
that the PNL is generated in the terms currency,
Okay.
okay?
Yes.
So I was just taking an example of a trade where you are going long at say 33.15, okay? And you are putting a stop at 1.3. So obviously if you go long here, your stop will be below the price at which you go long,
Yes, sir.
because it's a sell stop,
Okay.
because the stop order is meant to,
So you haven't put this buying stop, you put the selling
yeah,
stop.
this is not a buy stop, this is actually a sell stop,
Sell stop. Okay.
following a long position. That type of buy stop order which we were discussing in the case of cable, right?
Yes, sir.
That we were discussing here, you buy here.
Yes, sir.
That is a order, so you have to understand, because stop orders can be used both to enter the position and to exit the position. As you saw in the donkey and 4-week trading rule,
Yes, sir.
that system uses only stop orders.
Stop orders. Yes, sir.
They use stop orders to enter positions and to exit positions. So you have to be clear about, are you using the stop order to enter the position or are you using it to exit the
That
position?
was confusing because
Yeah.
at that time you were for buy, so I was confused that you were trying to put a stop at the buy or at the sell.
No, no. In the case of the Canadian dollar example, I was saying that I am buying at market where the market is around 33.15 and I'm putting a stop at 1.3.
Yes, sir.
Okay, that's what I was saying.
Okay.
So there the stop is to exit the position.
Exit the position.
And that stop in the Donkian system, the stop would be somewhere like here or here, okay, at this level or this level when a new high is being made. That is to enter the long position. Okay, so that's why I said that if you're a breakout trader here on cable, you're bullish. Actually, at this point, you don't have a view.
Yes, sir.
You have a view only when it makes a new high, and that's when you go long. Right? So it's clear? Okay. Any other question? Technical question?
No technical, general question.
Yes.
The paper will be of 200 marks or
Don't worry about the marks. The marks are not relevant.
30 marks is for trading project. So rest 70.
No. It's not a marks. Marks are different. Weightage is different from marks. The paper can have 700 marks also. But the weightage, 1 minute. The weightage is 30%.
For the end term.
Sorry, 50%.
50% for the end term.
Weightage is 50%. No, I'm just saying. Paper can have 700 marks
So only
also.
the project is of 50 marks, sir.
No. There is no marks. Don't think in terms of marks. Marks are irrelevant.
Sir, 50%
is for project and
for income and rest.
20% is supposed to be CP. Okay. Now, unfortunately, we didn't have time to do CP. Okay, because we have to cover so much material. Actually, I am not in favor of having CP for this kind of these finance courses because it reduces our time to cover material. We have to cover a huge body of material. So I will basically give you guys CP based on your project results. Okay.
No, sir.
I will. Okay. I will ensure that the CP marking is liberal because in this case, because we didn't have time to do CP, so nobody should be really penalized, except for people like SG1 and all who have been caught talking, and some other examples which our names are there in the sheet. Okay, so they will be penalized, but otherwise group marking will be. I will make sure that the CP marking is
So you
okay.
can do it according to your evaluation. Of
Yeah. I'll make sure that is okay. But essentially, that's what it is. CP is supposed to be 20%. Actually, I favor a system where the project is, because project takes up a lot of time. So project training should be 50% and interim should be 50%. That's what I favor. But then there's a rule saying that you have to have CP. And I was going to have CP. I have my CP questions ready, but we don't have time.
So what was the question?
What CP questions?
yes,
Right. Just
Now you can tell us. We can
maybe we'll have an extra session to
No,
have
sir.
CP.
No, sir.
No. What I'll try to. After your exams are over, I will request Lalita for. Please.
yes, no, go ahead.
Okay, can we close now? No more questions. Actually, I should have closed even earlier, but never mind. So wait.